Welcome to Kangaroo Accounting. My name is Professor Kang. Let's learn accounts the fun way. Firstly, I want you to think in terms of kangaroos instead of accounts. And we shall talk about plus and minus instead of debit and credit. Yes, accounting can be fun and easy if we take out those confusing technical jargons. All kangaroos have pouches to store values. These values are measured in terms of dollars and cents. Values flow in and out of the kangaroo's pouch. So, what is accounting? Accounting is really about recording the flow value from one kangaroo's pouch to another. Simply subtract the value from the kangaroo that gives and add value to the kangaroo that receives. Isn't it easy? Illustration 1. Recording the paid-up share capital. We have a kangaroo named Shareholder who put $100,000 into the pouch of another kangaroo named Bank Account. Hence, we minus $100,000 from the pouch of the shareholder kangaroo and add $100,000 into the pouch of the bank kangaroo. In accounting jargon, we say, credit the shareholder account with $100,000 and debit the bank account with $100,000. Minus equals credit, add equals debit. Get it? Now we have two kangaroos, namely the bank account and shareholder account. And the bank kangaroo's pouch is plus $100,000, i.e. debit value of $100,000. And the shareholder kangaroo has minus $100,000, i.e. credit value of $100,000. Illustration 2. Making a purchase. In our next illustration, we shall write out a check for $30,000 to purchase some stocks. We will need another kangaroo for our show, and we shall name him as Purchases Kangaroo. Here's what we do. Add $30,000 to the pouch of Purchases Kangaroo. Subtract $30,000 from the shareholder kangaroo. Now, we have three kangaroos falling into two columns. One with column has negative values, and the other column has positive values. See the table below. Shareholder kangaroo, minus $100,000. Bank kangaroo, $100,000 minus $30,000 plus $70,000. Purchases kangaroo, plus $30,000. In accounting jargon, we call this listing a trial balance. Can you imagine all the kangaroos inside a kangaroo enclosure? In accounting jargon, the kangaroo enclosure is called the general ledger. The general ledger is a home for all the accounts. Illustration 3. Payment for furniture and fittings. We write another check for $10,000 to pay for desks, chairs, and display cabinets. So we add another new kangaroo to the kangaroo enclosure and call him Furniture and Fittings. To record this transaction, we add $10,000 to Furniture and Fittings, and we subtract $10,000 from the bank kangaroo. Now when we take a peek into the pouch of the bank kangaroo, we will see that only $60,000 is left. History of funds movement in the bank kangaroo's pouch. Add share capital, $100,000. Minus value for purchases, minus $30,000. Minus value for furniture, minus $10,000. Net positive value left, $60,000. Now, we have four kangaroos in our kangaroo enclosure. Now, if we arrange all our kangaroos into two columns with positive values on the left and negative values on the right, we will have a trial balance as follows. Values, positive values, negative. Shareholder kangaroo, negative $100,000. Bank kangaroo, positive $60,000. Purchases kangaroo, positive $30,000. Furniture's kangaroo, positive $10,000. Illustration 4. Recording of cash sales. Let's now add another kangaroo and name him Sales Kangaroo. Assuming that we have total cash sales of $45,000 for the month of January, we will subtract the value of goods and services given out by the sales kangaroo from his pouch, right? And in exchange for those goods given out, we have $45,000 in cash that we deposit into our bank account. Hence, we we add $45,000 into the bank Kangaroo. Now do you see how we record the flow of values from one Kangaroo to another? Whenever we subtract value from one pouch, we have to add the same value to another Kangaroo's pouch. In accounting jargon, we say that we have credited one account and debited another. Debit and credit entries such as these form the basis of modern days accounting. We call this the double entry accounting principles. Cost of sales. Now, for obvious reasons, we will have to take stock of our remaining goods from time to time. Let's say that the remaining stocks at the end of January is $10,000. So what will be our cost of sales? Well, at the beginning of the month, we have no stocks at all. Then we purchased $30,000 worth of goods during the month of January. At the end of the month, our remaining stocks is $10,000. So the difference represents our cost of sales. Our cost of sales is $20,000. In other words, the fall in our stock's value is the cost of goods that have been sold in the month of January. Do you follow? And what about profits? Did we make any profits? We must know how to compute our gross profit. Now, our sales is $45,000, and we know that the cost of sales is $20,000. If we take our sales and subtract the cost of sales, we have our gross profit. Note, the gross profit is what the company has earned before deductions of operating overheads, which we'll explain later.